Okay, hi everybody. Could you just put a Y in the chat if you can hear me okay? I'm sure you can, but it's always nice to know. Thank you very much. Right, today we've got an event which is a little bit different from most. There's a guy, Rob from DTG, somebody I've been speaking to for a number of years, probably 4 or 5 years now. We tend to have these very long chats about trading, usually chatting about what's going on in the industry. Sometimes we're talking about the scammier part of the industry. And then sometimes we're just talking about what the markets are doing right now. So, quite often if the markets are in a bit of a funk, you like to speak to other traders to figure out if it's just you or if it's the market. So what I'll do is obviously the disclaimer's there. You can quickly read that. Effectively, what you're going to be doing now is eavesdropping into a discussion, and obviously you're going to have the chance to ask questions later on. But without further ado, Rob, would you just like to introduce yourself and kick things off?
Introductions, my favorite part. Yeah, so I guess most of the retail community knows me from DTG, acronym for Discovery Trading Group, which is I guess a community of like-minded, aspiring individuals. Most of the community has been predominantly focused on very short-term intraday trading, specifically price action and order flow traders, hence how I came to know Pete. But I think, what's the connection, to this discussion and many of the discussions that Pete and I have had over the years is that the community really isn't focused on, the usual trading education stuff, setups and specifically ways to enter the market, this obsession with entering the market as if that's really the only thing that you need to do to quote unquote learn how to trade, as if it's a process like a course that has a final destination. But instead, the people in the community are really focused on what we say is the stuff that matters, which in a nutshell is really changing the way that you think, being focused on the right things, specifically the interaction of the risk model, and how you can get edge from the risk model in any strategy that you trade. And then of course, my really big thing is aligning yourself to have reasonable expectations, because it's my personal opinion that whatever the stats are, I don't know what to believe or not to believe in terms of the percentage of retail traders that fail, although I think Pete and I are going to talk a bit about a survey that he did. But I think a lot of the people that fail probably are right there, which we find all the time with people working on their development in our community. But they're right there, and they're only failing because their expectations, who knows where they get them, are either totally outlandish in terms of likely percentage return on capital, things like that they're looking for, or maybe even more so linearity. People have a sense of a very linear performance curve, which we work on showing people in the industry. If none of your peers are achieving that kind of linearity, why is it that out of the gate you're expecting to do it, since it very rarely exists? So that's really what DTG is all about, is hardcore trader development. So although most of the members are kind of focused on what a lot of the users of the Jigsaw tools are focused on, they kind of run the gamut in terms of market strategy. Some are working on longer term non-correlative portfolio design, spreading, scalping, pure market making, selling offers, buying bids, and everything in between. So that's suppose that's a good overview of what DTG is all about.
All right, thanks for that, Rob. So I think the first thing you wanted to talk about was the quant versus discretionary model. So again, do you want to kick that off?
Yeah, so, I'm just looking at my notes here. I remember the first time that we first interacted with each other, um, somebody had put something in the stream about Jigsaw, and I remember saying, something like Jigsaw, Schmigsaw, or something like, because as this, I kind of look at what's happened with order flow, traders intraday kind of springing up. It reminds me of what happened with the big indicator craze when we went into the or had the electronic trading revolution, or whatever you want to call it.
Yeah.
When everybody started breaking markets down by history, very, very quantitatively and systematically. And at that time, it just seemed like, there were the original tape history tools, as I call it. And then all of a sudden there was another one and another one and another one. And everybody was trying to capitalize on this order flow revolution, because they knew it was something that would look really slick, and that they would be able to sell it as a magic bullet. And so that was my first reaction. Then somebody said, no, you should really, this guy's a real trader. You should see what he does. And I remember looking and being really blown out by the novelty of some of the things that you had in the tool, just as a matter of convenience for somebody who was interested in stuff like that. And then as I got to know you, I realized that you were a guy who didn't develop the software necessarily as, okay, I'm identifying a market and I think I could sell this. It was really something that you developed for you to use yourself. And as such, it had that organic nature kind of driving it. And I think that's why the tools have been so successful. But I remember in some of our early conversations, we were talking about quantitative trading versus discretionary, and where that crossover is, and how the natural course of action for retail traders is try to turn the reduce order flow tools into another, yet another red light, green light, magic bullet solution. And in that discussion about where that line is between viability of quantitative versus discretionary trading, and many people may know I'm a principal in a quant research firm, and quantitative trading is certainly viable across a lot of time frames, but not usually in the sense that maybe the aspiring retail trader would like it to be, in terms of it not being simplistic, requiring ongoing adaptation, especially for very short-term strategies. So, but when we had those discussions, we were talking about a book.
Yeah.
Right. So I guess we won't throw the author under the bus, but there was this book that was published, and admittedly, I haven't been much of a consumer of trading education materials, probably even less so than a lot of people, and that really doesn't have to do with anything other than just probably my personality and the way I like to kind of go about things. But I remember talking about that book, and basically this book is I don't remember how many were in there, but there's probably like a dozen kind of setups, right? Just, anything from fading ticks to, boy, I don't even remember. But anyway, in that conversation, that's how I learned about your process. So I thought that would kind of be an interesting part of the conversation, is for people who didn't know how that all came about with you in that book, and your interaction, the forums, and what you did with the materials in that book, and what kind of reactions you got.
Okay, well, and just some background on what I know about Rob, because he's just told you some stuff about me. Rob's got a really unusual background, and he's got a long background in proprietary day trading, right? And so, and this I will explain my story, but I just want to explain what I know about Rob as well. So he's got a long history as a prop trader, a discretionary prop trader, and but he's also involved in the quant business, and that's a lot longer term. And I'm not going to say too much about it, but it's a lot longer term, and it involves multiple instruments, right?
Right, large format, portfolio design, risk model development type stuff. Definitely not short-term focus in our quant research at all.
So when I got into this, I mean, everybody knows I got into this because I didn't really have an interest in trading. I just had a real interest in people stop losing my money. And so, you know, all the way back to the dot-com burst. And the funny thing was I had people managing my money. And at the same time, I was actually on tour all around Asia doing, I was a director of a technology firm. And one of the things we were selling technologies for taking your business to the web. But as part of that process, I was actually going on the road and doing presentations, you know, for Microsoft and, you know, these big presentations. Because nobody wants to hear about technology, I was telling them about all of the subterfuge going on with the accounting of all these dot-com companies and how they were kind of just the revenue is being made up, right? Because I was a director and I knew accounting. And at the same time, I had all my money being managed by people putting them into these companies. I really don't know how that I managed to kind of ignore it myself. But I was just completely green. And I got into this. And of course, I came across trading forums. And there was one book that at the time it come out, and everybody on all these trading forums was saying how absolutely fantastic this book was. This book was like gold. Now, this is a kind of trading forum where people talk about, you know, they start off on moving average crossovers, and then it's just like literally the forum used to be just a whole list of like how to use indicators, how to use various indicators and combinations of indicators. And so I've got into this and I'm like, wow, you know, everybody says this book is good. And so the book was very clear. The book was basically saying, this is a strategy and this strategy will make you money, right? Mm-hmm. And it was mechanical, right? There was nothing in there that said, you might have to do this or you might have to do that. And plus all these other people that read this book, they all said it was fantastic. So having a technical background, I coded up every single strategy in the book. And not one of them came close to the book's published results, and not one of them made any money. And it was just a shock. It was a double shock to me. First of all, because all these people, I'd gone to this trading forum, Green, and all of the people there who I presumed were making money, right, as you do when you first hit these things, right. They all said how good it was. And I went back to the forum and I said, look, I've coded every single strategy. None of them actually work. You know,
none of them.
And I was a pariah. It was like I'd said, I don't know, I'm going to probably offend some religious people. It's like I'd said Jesus was gay in a Christian forum.
Yeah.
You know, and it was just like, literally, I couldn't believe it. It was like, can we not have like can we not just have a balanced discussion? Can you tell me your experience? Oh, you're saying I'm not making money. And then I'm offending people because they feel like I'm questioning whether they're profitable or not. And it was a big eye-opener. And the funny thing was, that's one of the experiences that turned me the completely opposite way.
Right.
To being pure discretionary, because I went through a few things where I sank a lot of time. And I think you've got products out there. I was using TradeStation at the time. And if you look at products like TradeStation, certainly back the late 90s, early 2000s, they were very much about automation. But it was all automation on price and indicators.
Right.
Nothing else, right?
Right.
And
so it's interesting. So they were. So even though you were presenting them the facts of your process for coding, the risk overlays, whatever you're using, they were basically calling you a liar, even though it was.
But not only were they calling me a liar, they were every attempt at just having a rational conversation about it, they were getting really upset with me.
It seems like still, I mean, I haven't spent a lot of time on any forums, you know, other than our own, but it's probably still the case, right? I mean, there's still, is that environment, you think, still the same?
I don't know, maybe some people can chat. I don't go to many anymore. because of that, because they can be toxic places. But it's a little bit the blind leading the blind. So when you go there new at
Right.
first, you presume everybody's there, and people really love to give you trading advice,
Right.
regardless of whether they're making money or not. They really
Right.
love there to, oh, you should do this, it's really good. And
Right.
without, I just thought, oh wow, this guy's what a great guy. I'll listen to that guy.
Right. Right. So I think the part that amazes me about that, especially using that book as sort of a guide, is that entirely absent from all that discussion of all these setups in the book was anything to do with the risk overlay that's being used, or how you would adapt it to ongoing conditions,
Mm-hmm.
and what you could even expect in terms of what the results would be. Obviously, I mean, that's the most important part. And I still see that ongoing. Everybody talks about the viability of an entry scheme in a quantitative sense, but always leaves out the stuff that really matters with that. And I think unfairly so, the trading public is still pretty divided. I mean, you have people saying that quantitative versus discretionary trading sort of in a vacuum. Well, this is good or this is not good.
Yeah.
And the truth is, I mean, the simplest things like indicators, like moving averages and things like that are not only widely used in the industry, but are used in very successful programs in the industry. So it's not the indicator, and that's true for order flow too. Nothing is a magic bullet. There's a lot of pieces to the puzzle that are interacting, you can't quantify if something is good or bad without those other things attached. What's your definition of good? Is your expectation aligned with actually what's possible according to your definition of what good is?
Well, I think for that side of the market, and certainly even with a lot of people I work with now, the definition, what they're looking for, the thing that's like one system, all markets, all time frames, all this, all that. That's the one thing.
Right.
But there's also an attraction for something that's like you say, they want something that's constant. It's like
linear.
Yeah,
like they want linear.
Yeah, that doesn't change, so they can just reapply it. When the kind of, if you look at you could say, right, I'm going to look for something constant that never changes, that always makes money, and you will look for 20 years. Or you can say, I'm going to look for something where I know the markets are kind of shifting sands and changing all the time, but I'm going to look for something that helps me move with that. And that will be a shorter period. Now, if I read that book and in that book, it was saying, well, the markets are shifting sands. There are times when you can turn this on and turn it off, and you need to figure those out. And then that might have made sense, but that would also have probably not sold.
Right.
Because that's not what people want, because they believe that if you take into account all of the different things you need to, it becomes too difficult. So it's easier to kind of say, well, I'm going to do something easier and not take all those factors into account.
Right. And I think too, given that a lot of the aspiring or struggling traders that the group that we're talking about are working in that very small time frame space, which is undoubtedly, if you are seeking a degree of linearity or relatively predictable performance over a long period of time, the absolute hardest category to achieve that in is the smallest time frame, trading a single market intraday.
Yeah.
That's the strategy type and periodicity in our experience in quant research that requires the most ongoing adaptation.
As a quant trader, right?
Yeah, no. I mean, even as take quant or discretionary out of the picture. I'm just saying that in a vacuum, the smallest possible time frame trading a single market, you're not getting any benefit from non-correlation.
Yeah.
You are the most exposed to the ongoing, changes in the market, because the smallest relative changes to a larger time frame trader become huge or account breaking to a short-term trader. So, seeking linearity without adaptation, you shouldn't do that anyway, but God forbid if you are going to do that, the last thing that you want to do is to try to apply that kind of thinking to short-term day trading.
Yeah.
Discretionary or quantitative, and I think that people's minds about what a typical successful trader's results look like is highly misaligned. You hear all the time, we talk sometimes about this, the big HFT hating kind of thing, that goes around. They say, well, and they cite these sort of simple facts like such and such a firm, made money every day for blah, 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 and they never lose, So somehow that gets twisted and translated into, well, here's somebody who's trading, high frequency from the top of the book, order book, as we would say, in the microsecond space. And they always win.
Yeah.
It's like always making money every month and always winning are not the same thing. And so, if they dig a little bit deeper, they look at a typical model of a top of the book market maker, say in any of these futures markets. And what you see is, it's really just making a tick when you win, scratching when you don't, taking advantage of that speed in the microsecond space. And the win rate might be 20 or 30% in a lot of periods. But the difference is it's, when you lose for a scratch, it costs you 10 cents. When you win $12.50.
Yeah.
How many trades do you have to win trading hundreds of thousands of round turns a day with such a strategy? So at the end, somebody might look at the result of that over a long period of time and say, okay, well, this firm is doing it. They're trading order flow short term or whatever. And it doesn't even have to be microsecond. It could be in any other periodicity, but it's the same type of thinking where somehow the details of that interaction or risk overlay and the fact that it isn't totally smooth, maybe in shorter time frames, and it comes out in the wash over a month or a quarter or a year at a time, that just gets lost. And then the focus for that trader that's trying to develop their program, they're probably really close to already being there and they have great results, but they're going to keep going back to the drawing board until they win 3 out of 4 and make 10% in a month in and month out. So, that's why that reasonable expectation thing is a really big theme at DTG, because I think it's really hard for a lot of people to, at least in our experience that we've seen, to accept what good performance actually is in the business. So, and then what you had you told me about a survey that you did.
Okay. Yeah.
I don't know. I don't remember all the details, but I remember at least one or two of the numbers were mind-blowing to me.
The numbers, I mean, the reason I did the survey is because I had a couple of people come to me that they came to me and they said they'd been looking at trading for 20 years. And one of them in particular claimed to have learned nothing, but to have gone through the 20 years period and learned nothing. But
wait, he said he learned nothing in 20 years?
Yeah, I said, because usually when I talk to people, I say, okay, what have you done in the time you've been looking at trading? What did you do that seemed to work? So I have guys, I mean, I remember just a few weeks ago, one guy showed me this chart, right? And he showed me the way he marks up the chart before the start of the day. And I was like really impressed with the way that, it was putting quite a few, he was putting some, it was quite accurate in some places in terms of, estimating how far the market would go and for a potential reversal. But he was losing money on it, right? And the reason he was losing money on it was fairly obvious to me. It was because he was trying to trade the levels instead of using them another way. But he felt that he had nothing. So it was like, because he's kind of programmed to see it a certain way. If it wasn't making money, if that thing alone didn't make money, then it wasn't of any use. So it's almost as if people could learn lots and lots and lots of different things, but never be able to pluck one of those things out and say, well, I found that to be of value. There was no measure by which any individual piece of information could be validated or put above any other piece of information, if you like.
Mm-hmm.
So it was like basically, I learned something. If it doesn't make money, I'll learn something else. If it doesn't make money, I'll learn something else. If it doesn't make money, and I think a lot of it is a confidence issue, because they're learning a lot of it from people they don't know. Whereas if they'd actually met some real traders, they would probably elevate that and give that, maybe think there's some merit in it. But people are throwing away, they're learning stuff and throwing it away and learning something else and throwing it away, and nothing's really sticking. And there seems to be an issue. There's a couple of issues. Partly it's the expectation of what that information is going to bring them.
Right.
Also, there's an emotional thing where people feel, because what people do is they sim trade or live trade with some information they've got, and emotionally it's very difficult to carry on with something that's just lost your money. And also it's very difficult to focus on something when you've just had 9 losing trades in a row with something, because you try. I mean, I had a guy I was talking to earlier, and he'd had 9 winners in a row on one thing and 9 losers in a row on a different day. And he was like, it's obviously not working. And it's like, well, wait there. What was the difference between the 2 days? What was different about those 2 days? That's the first question, right?
Right.
So these are the stats. So a lot of people, it seems like 50% of the people that I talk to are 6 to 10 years plus. 50%.
Incredible.
And I mean, in a prop firm, after 3 months, they want you to make, they're giving you a sim account to make money or get your ass kicked out the door. Mm-hmm. And it's just amazing. And it's just, I don't know what it is. I mean, I've got a few theories, but I think, partly it's bad information, but also I think it's the expectation of what that information is going to bring, and no way to actually measure progress at all.
That's the big one. Yeah. Right.
Because it's either on or off. It makes money or it doesn't.
Right.
And
well, let's dig one layer deeper to just that statement. It makes money or it doesn't. Makes money how? For how long? I mean, for example, a guy who's an intraday swinger, as we call it, trading the ES for 2, 3, 6 handles maybe at a time, structure to structure, as we call it, intraday. If their expectation is that they're never going to catch a run where they lose 9 trades in a row, or they're going to win 3 out of 4 trades, and they're going to risk 1% and make 3 when they win and lose 1 when they lose. We see that all the time. There's nothing wrong with the model. A given model can only deliver, all other things being equal, what it can deliver. You're not going to have an intraday swing model that wins 95% of the time. Tick scalping, you might have an extremely high win rate, but then you're going to pay for it in other ways because you can't advantage the risk math the way that you can with longer term models. Mm-hmm. If you're trading a single market versus 2 markets, that junction between, and why people, we have a member, long-term member, resident pro, who calls that process method hunting. Yeah. Which is where they find something that they've learned or they're interested in. They think that they can exploit. There's, an inefficiency or an efficiency that they want to exploit. And it's great. They've done all the legwork. There's nothing wrong with it. But as soon as they, catch a frozen wave of cards, as we call it, they give up and they move on to the next thing. When if they would have changed their thinking from thinking about every individual event that they trade, and the result of that event as being evidence of either doing something right or making a mistake, and changing that from looking at an individual event at a time to groups of events, because that's what you're trading for, is the difference right there. In other words, like I said earlier, they're already there, but because of that twist in their thinking, they won't even know if they're there when they're there. Yeah. So I wonder, when I see these numbers, how much of it is attributed to that that process that just repeats itself over and over and over again.
I think a lot. I mean, you know, what I've been telling people to do, I've been trying to give people a framework for this and basically saying to them, okay, you've got your rules there. Instead of trading them, just for 2 weeks, getting and sticking same time of day, getting them to watch same time of day, writing down a few different rules and just track that, how it works. So it might be some trades that occur after the open and just track how many occurrences, what was the outcome of each of those occurrences. And then you watch what happens when they start to sim trade. That when they start sim trade, even though they know the rules,
Right.
they know how to assess the market state, to know if they should place that trade or not. And they've got the outcome and the expectation, and they know how to track the outcome and expectation. When they trade it, they can't reach those levels. They can't reach those levels straight away because they've got to learn how to trade it. So they know, but if you just get them tracking the expectation first, to the point where every day they can actually note down whether they're sim trading or not, how many occurrences and what were the outcomes. So if you know something over time is going to work, 50% of the time, but generally speaking, because you're leaning on something, you're going to get a better outcome than your loser. That's what you can aspire to.
Right.
And people don't have anything to aspire to. All they know is a result. But I've seen this time and time again. The moment people, even though if you gave somebody a profitable strategy with all the market state and all that, they wouldn't make money at it because they'd just suck at the execution part. And they can't differentiate between the market no longer behaving to expectation and them just sucking at trading it.
We say that in the research business, we could publish our best work on the cover of the Wall Street Journal and nobody would do it.
No.
So who cares, right?
Yeah.
That's the disconnect, that we see so often is exactly what you're talking about. And, even back to that, we just try to challenge each other to think about things logically, like, back to the intraday swinging thing, which is a very popular strategy. So you're analyzing what's going on with the market right now. So you have this idea that you're going to segment the market in a certain way, and this is what your trades look like, and you get in, and let's say on average, some of these people are in trades from 20 minutes to 2 hours. Just stopping and thinking and saying, of the notion that you're going to analyze the market right now, what's going on right now. And you're going to think that at the end of this trade, whether it's a win or lose 2 hours later, that what the market is doing at that point, has F all to do with what was going on at the moment that you analyzed whatever the situation was that got you into that trade is absurd, right? Because in between the 2 points, you have an ever evolving environment where this decision's being made and somebody else does this and that has this effect on price. And because that was the effect on price, other people do stuff, and then other people do stuff because they do stuff. And the next thing you know, you can't make that connection between an analysis at any given point in time and what's happening X minutes or hours from now. It's ridiculous. That's why, I'm not saying there's not edge in it. It's just not going to show up event by event.
Yeah. I mean, one of the things you got to remember is on the retail side, the stuff like Jim Dalton's stuff, the market profile stuff that people
the profile
read.
stuff. Yeah. Mm-hmm.
And one of the things you've got in there is the concept of day types. It's this type of day. And it's like, and I try to get people thinking it's like, it's not changing minute to minute, right? It doesn't change every minute, the market state, but it's certainly like, it'll do something for 10, 15 minutes and then it will do something else. It might carry on. And I think the other thing, so you've got a lot of people selling this idea that based on the way we opened, you got 6 or 8 open types and then that many day types, that's it. That's all the market can do.
Right.
That's your market state. When we all know that actually what it can do is it can change time to time. And there are certain things that you can watch. It will help you understand when it's shifting modes and what mode it's in now and help you set your strategy. And then just the one other thing I'd like to say is that people don't understand the scope of a signal. Like because the market's linear, the market can only go up or down. But like on any one event, that event is only going to produce a move of a certain size. If that event is based on traders being stopped out, that's not going to move the S&P 100 points. Now, if the S&P moves 100 points because after it happened, it's got nothing to do with that event.
Right.
It's things like that people don't really think through. But the eight types a day or 6 types a day, I think that's, I find it hard to correlate to what goes on in the markets.
Yeah, I couldn't agree more. That, you know, again, this is like a lot of people, I think, want to skip over this stuff. You know, the thought thinking through beyond whatever their entry criteria is. And it's the most, I mean, it's everything, you know. What do you think, in other words, if you had to kind of peg it to one thing, do you think that the retail struggle is mostly about the method hunting, or do you think it's psychological? Or
I think it's when you first get into trading, the material that you gravitate towards, or the material that's available to you, there's still a lot of people reading books from Barnes and Noble, which are fairly useless. It's all that indicates things. So I think basically there's an expectation set up about what trading will be. And it's a very simplistic expectation a lot of times because somebody wants to sell you they want to sell you a setup, right? And so you've got like moving average crossovers. Just this line goes over this line, you'll make money, go away next. And although the market's evolving and things are becoming more complex, I still get people coming to me all the time and saying, you know, so we do a refund thing and our refund rate is about 5 to 10% depending on the type of market we're in. When the market slows down, it's nearer 10. When the market's volatile, it's nearer, it's 5. And the number one reason people come back, and we say, look, you get a refund if you don't like it. The number one reason people come back with is, I'm looking for something simpler. And I'll often ask, just out of interest, how long have you been looking at trading? And I go, 7 years.
Yeah.
And it's like, how long,
yeah.
you know, how's, you know, 7 years looking for something simple. And the reality is that it isn't that complicated. It's just, you're going to have to learn some of it this month, some of it next month, and just keep building, you know, just building up your knowledge and just bringing stuff in. So that's one of the causes. But I think the main cause is you don't have it's very difficult to trust anybody to the point where you can go through that painful process of learning to trade. It is a painful process and there's a lot of stuff to learn. And it's very, you know, you've been told it's simple, you lost money. Somebody else sold you a simple solution, you lost money. Somebody else sold you a simple solution. And it's like, it's difficult to stick with something because you don't know the credentials of the people you're dealing with.
Yeah.
You know?
Yeah.
But in a prop firm, you do, right? When you're trading prop, you know, the people around you, the people that are teaching you have a vested interest in your performance as opposed to just trying to extract money from you.
Right. Right. Yeah. I think that's so, yeah, that's important. I mean, it's definitely important to be around like-minded people that you know are speaking the truth. I think anytime there's like any kind of guru thing involved, that should be a red flag. You know, anybody that says that they have the answers, you know, because, you know, the journey is the destination, right? I mean, there's no, you don't ever graduate as a trader. You know, I don't know anybody that's successful that would tell you that. It's just, you know, you're constantly figuring out how to adapt to the environment and do what you need to do. So, you know, anybody that is telling anybody that they have this red light, green light solution that will just continue to deliver is lying to you.
But Ned, I just want to ask you one thing though there, because this thing about when you talk about that constantly adapting, it scares people off, right?
Yeah.
But how much?
Sorry.
So, no. But the thing is though, because somebody else has put a comment in there that people are lazy. I don't think people are lazy because I've seen people, I talk to people and say, you're going to have to spend less time at the screen. You're spending 12 hours at your screen, not making any money. You need to stop, right? So they're not lazy, but this thing about constantly learning. To me, it's a natural process anyway. Once you understand that the market's a learning experience, if you're watching that screen every day, it's not that difficult to evolve with the market, in my opinion.
Right. Well, it's like, I come from a background of games, gambling, and, it's the same. I mean, you have to, it's like playing poker. You have to adapt to a multitude of situations. Obviously the game that you're playing, who you're playing against is huge, and what the stakes are, and tournament play, what the tournament structure is, and it's never the same, right? So you have to be okay that you're in that kind of an environment, and you're not, and I think a lot of guys come from technical backgrounds, the architects, the doctors, the engineers, and nothing against any of those professions, but in most of those professions, there is a beginning and an end, so to speak, right? There's a manual, there's a process. This is the way it is, and you digest it, and then you do it. Now they're entering an environment that's liquid, for lack of a better word, and it's just constantly changing in ways that are not necessarily going to be easy to be measured.
Yeah.
And a lot of it is feel. I mean, I remember right around the time that I stopped trading outrights as a scalper in the S&P. And it's done this many, many times in the past, and continues to, as you know. But with that particular deal that I had at that time with my partners, there was a certain liquidity requirement for the strategy that I was executing. And the market went through a period where it got really, really thin in terms of book thickness, number of orders up and down the book, for people who don't know what I mean. And that lack of density in the book was having a significant effect on the scalping or market making strategy that I was employing. So I stopped trading that market, even though otherwise there was really no other reason to do so. But I had to recognize the situation and adapt. And so I guess somebody who maybe wasn't prepared to adapt or to notice how things were changing that might impact the way that you're trading. I mean, it probably wouldn't have made a difference on 10 other people trading the same market in the same way, but because of the size that I was clipping and a variety of other factors, it did matter to me. So even that's not linear. It's not like, oh, well, the S&P is too thin, so you shouldn't trade it. Well, maybe if you're a 1 or 2 lot trader, you could use that to your benefit. But if you're clipping in the mid 200s, like I was at the time, I'm getting swept. Like I can't move. So, I think that adaptation thing is something that you just have to learn to live with. I mean, you have to almost embrace it. Like you're constantly a student of the environment. And, I think like what a lot of our members that are trading the S&P, for example, are working on is that, not deciding not to trade is a trade.
Yeah.
That's a decision. So you have a particular way that you have found that over groups of trades, you could, with a certain risk overlay, you can find edge in that environment. Well, when you recognize certain contextual situations, you don't have to trade every day.
Yeah.
Some of the best strategies in the world are fairly infrequent during certain times when it's not appropriate to get what it is that you're looking for. So
yeah. And some of that's predictable. I mean, like the rollover. I never trade the rollover. Although, even that changes. It used to be the rollover. I used to hate trading that. It used to be low volatility time, and then that changed. And now the rollover takes longer because it's almost as if people were taking advantage of the people rolling. So the rolling now takes longer. And,
well, very different now because, if you're trading the spread market, like for the ES, for example, you got a tick that's 1/5 the size of the 1250. So, think about high frequency participants, and, there's a lot of meat on that bone for those who are fastest. So they drag it out and try to exploit it as best they can. So
Yeah. Now, one of the,
definitely, that's a great example. It's very different now than
one of the comments is that even the most experienced traders don't continue to learn or want to hear anything beyond what they believe to be true. Now, I think there's two things there. There are also, I would agree that some people don't want to learn, but I also think there's a framework that you work within. I don't know if you agree with this, Rob, but there's a framework that you work within, and you don't want it, and really you need to stay inside that framework, right? So
can you define what do you mean by framework?
Well, some of it is lucky rabbit's feet, right? There are some beliefs that you have. I mean, I know people are making money with stuff that I don't believe in personally, and I ask them how it works, and they can't explain why it would work. And to me, it's like, it doesn't mean that that's the reason they make money. It just means,
well, they may be getting edge from the risk model, and it really doesn't have anything to do with the entry. That's a great example.
But they actually feel that they need that to trade, right? And but also, for me, I'm a discretionary trader, and so as a discretionary trader, I have certain beliefs, but within that belief framework, I'm flexible. But I'm not going to start trading Fibonacci's tomorrow,
right?
Because it's outside of my belief. My belief framework is, if I can try and understand where, really, really understand why other people would trade after me. If I've got something that in the market where I can say, in this case, I believe there's a good chance that people will trade after me. It won't always happen, but I can understand why they would do that. And anything I do has to be within that belief framework. So if somebody says a moon phase or a Fibonacci, I look at a Fibonacci and I say, well, it's snail shells, right? Or it's leaves. How does what would somebody believe? Because
I really only have, I think, anything strategically that I've had my mind into over the years. It sort of all goes back to, maybe one mantra is that I believe in crowd behavior. So, and that can often be a self-fulfilling prophecy. So if somebody could wax intellectual about why the 200-day moving average is meaningful, and I would say something like, if everybody continues to think that it's important, then they'll be making decisions to trade long or short across the range of periodicities based on it, and maybe there's something that I can exploit there. But the crowd behavior really is the only the only trading god that I really pray to as a general rule. And I think that's what you're talking about. And I know a little bit about how you trade specifically discretionary intraday, and you're looking for those opportunities where crowds are going to be one way or the other. And you would like to take advantage of their psychological reaction when they're not the right way.
I also try and do, before the day comes, I also try and look at what are the big levels that we might move away from, and also try and predict. I'm not always right, but I will try and predict, actually, because we've hit this big level, if we actually move away from that level, this direction, it's going to be crap because we're moving back into an area we traded a ton for the past 3 months. But if we move upwards away from it, I believe there'll be more participation. Now, it doesn't always turn out to be true, but it's kind of that's my higher time frame. That's my higher time frame of, I think if we go up, there'll be more participation because I think people will believe we've broken. And then I look at, so I try and predict where the volatility might be, or which side might be more volatile.
Right.
And I would really like that to happen, but it might not. But then I'd never trade a level. I would never trade a level because I would like it to hold before I do anything, because I don't want to be the person turning the market around. I would rather be the person afterwards. But
I mean, it just goes to show you, I mean, that depending on what, and you and I have had conversations about this back, when I was trading outrights in the ES. I remember pretty specifically that, the contrast there, because one of the tenets of that particular strategy for me was actually just the opposite. Using size to my benefit. I don't want to be the first one in. When it's the most horrible situation for anybody to imagine buying, I want to be the guy sitting there taking the liquidity, right? And then flipping it right back out before, anybody else really even knows that anything's happening, sort of, in higher time frames. Whereas, just that one couple clicks later, you're looking to see, okay, now what's just transpired, and, and has the illusion become real in the minds of other people? And then, you're going to trade on the back of that.
Yeah.
So, there's no, I guess the main message, there's no right or wrong. I mean, there's anything, and I firmly believe indicators, whatever, anything that you believe in or that you think is viable can be crafted into a profitable trading strategy. But you have to, have reasonable expectations for what that strategy is, what it can do, and what that curve's going to look like over a short, and long period of time. And it doesn't mean it's not viable. I mean, for example, we send people to the databases all the time. So futures traders at least can get a sense of what asset managers in that business actually are doing in terms of performance. They're not using the capital as efficiently as we like to call as short-term traders, because they have to meet a certain profile for what their inevitable drawdowns are going to look like, so they don't lose all their clients. But if you start looking up, you start looking at all the grids of all the performance of people in the business that are managing the most money, you see red in them. They're not winning at a linear rate month in and month out. None of them. Nobody is. And so that just goes to show you, typical, longer term, long short, multi-market, managed futures program, maybe wins 6 months out of the year, loses 6 months out of the year, makes a little bit more in their winning months than they lose in their losing months, and they're, grinding out an annual return. And the point is that what's driving a lot of those programs is the most simplistic stuff in the world. But, if your expectation is that you got to get it linear, and you're not going to be happy until you're doing any strategy that you want in any market and winning 80% of the time and making 12, 15% a month, I would just say, okay, show me another guy who's doing that.
Yeah.
Anybody, and it doesn't exist. So it's like, maybe you should ask yourself why your expectations are so inflated. And then people go, well, and then they come with the excuse of, yeah, but I only have a $25,000 account. How am I ever going to quit my job and become a day trader and make a great living? And I go, you're not. I mean, what do you want me to tell you? Want me to tell you should, you should pursue the dream of making 10% a month on 20 to 25K and getting that at a linear rate. I mean, it just, it's like, and having that make your living. Well, I mean, you got to compound, make a more reasonable return, build up your, money, go get some partners and, raise money in prop, become a CTA. Like, what do you want me to tell you? I can't, I just think there's so many people selling that dream. Just, here's your small account, learn how to trade. And, before you know it, you'll be making 7 figures a year. And it's just not a common success story.
No, I mean, I think people that there's a lot of steps in between. So people, I mean, there's a few things that people don't understand what discretionary trading is, because when I meet people who talk about discretionary trading, they think there's no rules. And it just means trying to, batting in and out of the market all the time. But they also don't realize what some of those beginner prop traders that are getting professional advice are making a day, even with backing. I mean, the guys I know, the guys that are starting to make it in prop, it's like $200 or $300 a day backed, not on a $25,000 account. And they've got they can lose a grand a day.
Right.
And they won't be automatically kicked off if they keep doing that. But, they don't, if they lose more than the grand a day, it's frowned down upon, but it's also considered in the context of what that day was doing. Right. So, and that, like the couple of $100 a day. And it's like, if there's prop traders, making those first steps, those first profits, probably 3 to 6 months after starting a prop firm, $200 to $300 a day, just to get consistent on a couple of setups. It's like, if they can take baby steps, it's like, is the guy at home doesn't seem to be prepared to take those baby steps. And that might be $50, $60, $100 a day. It's got to be better than You know, and to me, $5,600 a day is that's your target. That would have to be over multiple trades from
Right.
my perspective, because if it's one trade a day, you've then got the risk of it's going to go away. Whereas if it's,
right.
so there's a
Well, and
risk.
again, depending on the strategy, I mean, the type of prop trading you're talking about too tends to be, very short term.
Yeah.
Outrights are spreading, order flow related in some way typically. So it has a certain character to it and a likely performance curve, that you can see. So it's more about, and for prop firms too, everybody looks at that's sort of a, I don't know, that it can be used as a blueprint, but you also have to watch out because, a lot of prop firms in terms of their business model isn't really so much about traders on their desk making great
No,
returns. They're really in the fee arbitrage business.
absolutely.
So, you have to ask yourself, you see these desks where, you got 20, 30 guys or whatever, and they're all spreading short-term rates, on the curve.
I like spreads.
But I mean, the point being,
Yeah.
it's like, why would you think they would do that? Well, I'll tell you why. Because the guy whose money it is, he knows every day that the combination of what everybody's doing, the book is square. So he can't get killed. And these guys grind trades, and he's paying X for the trades, and X times whatever is being charged to the desk. So even if theoretically everybody, doesn't make money or a few people lose money, he's still to the good.
Mhm.
So, it's everything has to be quantified is my point. I'm not trying to slag on prop firms that are running
Yeah, but I think
fee arbitrage models. But,
I think the term fee arbitrage is quite generous.
well, it is what it is, but, it's a business. So, you got to do what you got to do. But, at least in those firms, or a lot of them anyway, the traders are interacting, with each other. So they're at least probably getting pretty good advice about what matters and what doesn't matter. Or at least we hope so. Whereas, unfortunately, I think for people who haven't gone that route and they're just, trading their own account and kind of pouring through the reams of dreck, that's all over the internet about how to trade, or what's important. Again, I mean, I know I just keep beating that dead horse, but the how to trade is like, it's like a given. It's like learning the rules of a game or developing something or learning how to swing a hammer or whatever you got to do. But the nuance, especially in this business of all that other stuff that, many of those points that we've touched on so far, is probably going to be what makes a difference. The first being a given and the second being, in other words, you could learn how to use the Jigsaw tools. You could understand relationships of everything. You could try to mirror what Pete does. You could try to trade like him. You could do all these other, things and do them, to the letter. But if a couple things are different about what you're doing, about, you changing something because you didn't like that you had 2 losses, or, your risk overlay is not adaptable, or you're just, when Pete's flat, you decided to, gun it and, take 3 more trades or whatever, even though those are seemingly small differences, that's, for a good model, I mean, you only might be like 2, 3, 4 trades ahead, as we call it, in a great month. You know what I mean? You win, you lose, you win, you lose, you win, you lose. You're up 2, 3, 4 events, and depending on what your risk overlay is, and it's you made 2, 3, 4% a month. I mean, again, back to the reasonable expectations. That's not enough. It's got to be 40% a month. I mean, it's like, I think a lot of people just, they're right. Like I say, they're right there, but they're only losing because they keep pushing an envelope, trying to achieve what can't be achieved within a given strategy. So,
yeah, I think a lot of people would like to be that successful, though. I think a lot of them, they're not really pushing it. They're just a lot of people are just falling over, those very early hurdles. A lot of people don't make it as far as the point where the gambling becomes a problem that's causing them losses. A lot of them are really not getting past stage. Now, can I ask you, when you say risk overlay, can you explain to people what you mean by risk overlay?
Yeah, I mean, looking for any given strategy, and really down to some specifics. I mean, it depends on how much you really want to dig into it. When we talk about risk overlay, we basically mean really two components. One is how efficiently are you going to use the capital? So like if you're a futures trader or an options trader, or anybody who's trading a derivatives product, you have a you're using leverage. So oh my God, the locusts are here. We can you hear that?
No,
Lawnmower.
locust.
Does that sound loud to you or
No, I can't hear anything.
Oh my God, there's I call them the locusts when the landscapers come outside. So,
okay.
Okay, I lost my train of thought. Yeah, risk overlay. So, how efficiently that you want to use that capital obviously has an influence on your results. So, like for example, the norm, and I'm not, believe me, I have to be very careful about what I say here because I'm not suggesting that anybody should trade a certain size or that you should trade at all for that matter. But I'm just saying because it's not for everybody. But it's the sort of the general consensus. Well, you trade a one lot until you're a superstar and then you can raise your size or whatever. That's a pretty common belief. Mm-hmm. But like the efficiency of capital is what size you trade against the equity that you have.
Yeah.
And depending on other parts of the total risk, a lot of people think of risk as just, well, sure, I manage my risk. I have a stop loss on every trade. That's my risk model. It's like, that's not risk management. So it's the efficiency of capital thing is, obviously if we're talking about reasonable expectations of returns. So a guy who always trades a one lot, say on a $25,000 account, and, let's say, typical events, he has 1% of risk or whatever is what he risks to the stop point. Well, based on what he wins on those trades, that has a certain profile. And then that, gets divided back into the equity. So you get a sense of what you make or lose on a given trade. Mm. Well, now if you trade 4 lots instead of 1, well, guess what? That percentage is 4 times higher. People say, yeah, but I'm taking more risk. Well, maybe, maybe not. How many events do you have? Are you trading? Is your typical event averages, are you doing 2-3 trades a day, or are you doing 20 or 30 trades a day? Because the more often you're in the market, you're assuming market risk, which means that you're exposing yourself to black swans, right? You can get crushed, you get stop gapped, you get killed. So all those things come into play. Mm-hmm. So it's really, again, changing the way you think. It's a point of analysis. It's not a question of right or wrong, but for one guy and a specific strategy that he's trading, it might be appropriate for him through what he knows about his strategy and what he's analyzed about what goes on in the market that he's trading, that like a spreader, for example, wants to extend duration to basically wait until he's right, for lack of it's a sort of a simplified description, but it's trading that spread that's allowing him to do that. And so because he could do that, maybe he could trade a bigger size. But then once he does get his win, maybe he doesn't take any more market risk and he quits for the month so he can lock in that return. For somebody else, maybe, or another strategy, a certain risk overlay, you're trading more events. So you are only trading that one lot against a certain account size. So, it's the same thing with the event count. People say, well, how much should I risk? But this, by the way, is what everybody in our community is constantly working on. So because it's never really a simple answer, because the strategy that you trade, obviously, the periodicity that you trade, the market that you trade, obviously, say you're trading outrights in the 2-year versus outrights in crude, WTI or Brent. Yeah. Way different, like they couldn't be more different. So the risk overlay that you put on the 2-year strategy that basically does the same thing that you're doing in crude oil is going to be different. What's your risk reward? How do you adapt that risk reward? We don't really subscribe to the idea of fixed tick risk and reward. I mean, because it doesn't listen, to what I trade with a 6-tick stop and a 12-tick target. So when I win 2 to 1 on my money. That sounds good on paper, but in reality, it's just like everything else. It's not going to be linear. Maybe over time, your strategy over, a month at a time, you're kind of averaging 1.5 to 1, 1.6, 1.4 to 1, maybe on the risk in a certain strategy. But on the 2 trades today, maybe it was 1 to 1 or less to 1 to 1 because the market was kind of stally and grindy and you had to get out earlier. And so that's how it played out that day. Another day you have a big kind of blast, some news, range expansion type of, conditions, and you're getting in the same kind of trades that you did yesterday, and you're making 4 to 1, 5 to 1 the money. So it all goes into the pot, creates an average, and that against the size that you trade against the equity in the account, and your efficiency of capital, as we would call it, concerns, is the risk overlay.
Mm-hmm.
So I guess that's kind of the long way around, but I kind of have my own terminology for this stuff. I don't know if anybody ever said risk overlay necessarily but me, but maybe they did, maybe they didn't, maybe I got it from somewhere, I don't know, but that's what we mean. And that is, again, this is one of those, it's everything, because so everybody gets hyper focused on talking about the specifics of how they enter the market and the read of this and the read of that. And it's like, okay, great. So that's working for you. Good. And then you ask a simple question. What's your average number of events per day? What's your average number of events per month? How much do you risk against your equity per event? Theoretically, black swans aside, to your stop point. Crickets. You can't hear anything. And then you start saying, well, that's the stuff you want to put in the blender so you can analyze your performance, see where you're at. Am I doing well? Am I not doing well? Could I take the same strategy that has a certain risk overlay, use the capital more efficiently, and run a quit scheme? And now you're like 1 trade ahead, 2 trades ahead, and you're up 2-3% quit for the month. Mm-hmm. See you on August 1st or whatever. That's a viable, strategy. So it's like all of this stuff can be tremendously impactful on results. So obviously that combined with you having reasonable expectations of what you could even get out of a certain strategy, in any given strategy, what you think that what you've been spending, like these guys that have been, they spend 10 years pursuing one strategy, so they haven't learned anything. Mm-hmm. Maybe that one thing that they were doing, or that the thing that they liked the most of what they were doing was like a totally viable thing, and they could still be grinding it out today and making money. Yeah. But unless you take those steps and look at all those other components that interact with the way that you enter the market, and that over obsession of how you enter the market, you'll never know. Yeah.
It's funny because it almost goes back full circle to implementing a strategy from the start. I mean, I've been working with people lately, and there's been some really interesting questions. I've been saying, okay, what's the event? I said, what's the event and how frequently does it happen and what's the outcome? And they'll say, well, should I sim trade it? And I'm like, well, no, because we don't even know what it does. And and I'll give an example, if you find it fails like 9 out of 10 times, when it fails, it's in 2 ticks, and when it works, you get 1,000 ticks. It's a great strategy, right? I said, but unless you actually know that, how are you going to decide how to trade it? You might find that this particular edge only works if you scale in. It only works if you scale out. It might, it might be that, when it, whatever the edge is, it might be that when it runs a long way. So scale into it, take more risk as it progresses. And it just seems like that people want to, it's like, should I sim trade it? And it's like, well, do you know what it does? No. Well, then what are you going to do? I mean, I've even had guys that have done this, and I said, what's your edge? Or what do you think the edge is? I'll say, okay, go away for 2 weeks and quantify that edge. Watch it. And they'll come back to me. The one guy came back to me, it was really telling. He said, Pete, I was looking for this. He was looking for small ranges, but I've actually noticed that what happens is I think I can actually play the breaks fairly well. And he said, do you think it would be okay to do that? And it's like, that's what you can see. I mean, it's like, somebody's been beaten up that much by the market. They're actually asking permission to investigate something they've seen in the market themselves.
Right.
I can see this over and over and over again. I've just spent 2 weeks just watching the markets over and over and over again. Do you think I should focus on that? It's like, yeah, but next time don't ask me, because it's like, it's just a lack of confidence. But it's like, it's not really, your risk model, to me, it's all the same thing. It's like, how often does it happen? What happens? How am I going to trade it? What can I read? It's all the same thing. And then is it still happening? Is it changing? What are the changes? How does the market affect it? And you're just always building up information and always building up stuff that you've got to figure out how to react to,
Yeah, you've touched on an important point, and this comes up a lot too in the community. The people that we see that seem to do the best have an inquisitive nature.
Mm-hmm.
They like they like the process of exploring and seeing how things play out and relationships between certain things. And I think that's kind of a prerequisite, like you say. I mean, I think you have to have an inquisitive nature and want to kind of do that work and run those what if scenarios on any strategy that you're pursuing, so you kind of know where you're at. We call it manual back testing. That's another one of my dumb terms, but I think it's important to not only sort of go back in recent history, but spot check odd times historically. October 2008 comes to mind when 6 ticks of noise became 60 ticks of noise in a given market, or things like the flash crash in 2010 or whatever, and kind of seeing, in really crazy high vol conditions or low vol conditions. For instance, if I traded the way that I trade whatever this strategy is today, what would have happened to me on X date in October of 2008? And then they go, I would have got murdered. I would have lost 28 trades in a row. Why? Why did I lose those trades? Oh, I see. My stop was too tight. Why was my stop too tight? Well, you're not adapting to the volatility in the market. So maybe when the market's really quiet, you're trading 4 or 5 lots, at a time, and meeting a certain risk requirement against your capital. Well, when those stops that you're typically trading with in the 4 to 6 tick range need to become, 5 times that big or more, well, then instead of trading 5 lots, now you're trading a 1 lot in those volatility conditions. And when you lose, you're losing a similar, again, it's not going to be linear, but a similar, heat to your equity on your events. And so that process, I think that's what you're kind of referring to. I mean, you got to have an idea, have a thesis, say, this seems to happen all the time. I think I can exploit this in some way. And then you got to do your initial digging to find out what resonates with you in terms of, just the general way that you're going to frame a risk model. Well, then you're still not done. Then it's like the context adaptability. Is it like this every day or not every day? When does it kind of bend out of shape in terms of what I'm trying to do and why? And what does that look like? It's not easy. I mean, it just never, that's why we're really big in this no guru thing. Cause we just, the founders and the resident pros at DTG are the first ones to say, we don't have the answers. I mean, when people ask me if I have the answer, I say, I could tell you what is not. But as far as, some roadmap to, where you as a trader are going to find your success, short-term scalping may not be appropriate for you. That's another thing is, the other founder of DTG, NJ, and I, we would joke, I don't trade the ES anymore, but we would joke about how, he sort of has that longer term investor's mindset, and he trades a lot of strategies, but as far as his intraday work in the S&P, it tends to be trading for, really big swings, kind of placeholder stop, a lot of kind of active management. He has a certain way that he does it. And I would joke and say, you waited all that time to get your money? I would just, I'd just rip my arm off before I could sit, longer than, longer than 5 seconds, because I just always had that kind of scalper's mentality when it came to very short-term trading. Well, guess what? If he tried to convince me to trade like he did, or if I tried to make, bend him into, having the mindset that I had for trading the ES, we both probably, would have had a harder time than if we didn't do that. So, I think you have to know if you start working as a scalper and it's just too fast for you and it's scrambling, and you just don't like it, well, then don't do it. There's it's an endless universe of things, that are available to you that you might find that, like we say, resonates with you, strategically. And, don't, be a leader. Don't be a follower. I think that's, kind of the best advice there. But
yeah, that's what I say. So when I talk to people again, one of the things I say is, what markets do you like? And so then I say, well, I want to trade what you trade. It doesn't matter what I trade. What do you like? What do you like watching? If you don't like watching it, it's like treasuries, right? A lot of people say, well, I want to trade treasuries, but I find them really slow and hard to, I find them really slow and I lose focus. And it's like, well, you ain't going to trade treasuries ever. You can't, it takes a certain type of personality to sit there and watch a market that's not moving. When I met a girl once and she trades Q positions on the 2 year. Oh God, I can't imagine 15, 20, 30 minutes to get a fill. Not even time in trade, just watching your position in the gas.
Oh, that's nothing, bro. Complex Eurodollar spreads or your IBOR or whatever. Days of working orders to get a fill.
But it takes a person.
I remember talking to you about that. You're like, oh my God, I'd go crazy trying to trade slow like that, So everybody's different, You gotta find something that speaks to you and then just dig into it, and like I say, I don't think you're ever done digging.
No.
None of us have ever been done digging. It's like perpetual, digging, to find new ways or better ways to do something or to think about something or, I think to a certain extent you have to learn to love it. And I think that's probably it becomes more and more true the shorter term, that you trade. I think, longer term kind of hands off, you can be, you don't have to maybe quite be so engaged,
do something else, right?
Yeah, exactly. So, but a lot of people, obviously they want to trade short term. They like a lot of other aspects of the short term trading and what it can deliver to them. But I think that's an important point too, that it just may not be for everybody.
Yeah. Okay. Right, can we do a few questions? We've been an hour and 20 minutes and we've got to.
Wow. See what happens when you and I get wrapped.
Honestly, so there's been.
I thought I would have guessed it was like 45 minutes.
We've been on for an hour and a half, 2 hours before now, and more, and it's been like 5 a.m. here, and my wife starts to get suspicious. Who are you talking to in the middle of the night? And but when they say my wife wouldn't understand me. Well, that's like really, it's really true when it comes to trading because like your friends,
sure is.
Your wife doesn't want to talk about it. Your friends don't want to talk about it. You go to a party and talk about trading.
Yeah.
People just, okay, I'll have my friend over there. There's a couple of questions. Somebody's asking, I know the answer to this, but you can answer it.
Can you, where are you seeing I can't see.
There's a chat. Can you see the chat?
Oh, right.
It's mostly they've been chatting amongst themselves as well. Somebody's asking if people buy order flow in futures markets like they do in the equities.
Do people, do they sell? What is he talking about?
You know how like TD Ameritrade sell their order flow tonight and stuff like that?
Well, yeah. You have to remember though that in the equities markets there's 13 exchanges now and maybe 70 or 80 dark pools. So a big part of that, the incentive for purchasing order flow is for latency arbitrage programs, maker taker models. So no, because it's it's the top of the book's wide open. There just really isn't any.
Yeah, that's the advantage of futures, isn't it? We all trade in the same place.
Right, exactly. One location for the market. Yeah.
At the moment, till they change their minds about that. And then the other one that we always, the terms, there's a lot of terms that get bandied about. One of them is trade like a market maker. Could you somebody saying, they hear about this thing, trade like a market maker all the time. Could you kind of firm that up a bit or kind of explain what you mean by trade like a market maker?
Yeah, you know, yeah, yes and no. I guess I hate for it to be. I don't mean for the answer to be wishy-washy, but it can mean different things depending on the objective of the strategy. Like for example, in at DTG, we use the we use certain terminology to delineate between certain strategies because since everything's relative, people don't want to be thinking, that something that's said that somebody says necessarily applies to everything. Because like you got a guy that's trading intraday swings and then you got another guy that's a scalper. Well, we use the term market maker, for example, at DTG to differentiate between the type of scalper that I would say Pete is and somebody who is only trading offers against bids. Their only objective is to cross the spread. So as a wide kind of view of market making, that's an example of how we delineate that. However, a classic specialist on the floor of the NYSE, market making is really about maintaining an inventory of of buys and sells across a book to where they're basically crossing the spread, but it involves the management of a lot of positions. So they're basically trading for an average inventory position over time. If you're talking about high frequency traders, for example, we talked a little bit before about latency arbitrage, payment for order flow, whatever. But the idea being that, they want to sell Apple on ARCA and buy it back on BATS. So taking advantage of an inefficiency, and they're really just stabbing at it one trade at a time, which ends up just being a giant spider web of working orders wherever they're able to manipulate, use speed to manipulate the book position. So market making can mean a lot of things, but generally speaking, it kind of means that you want to be the first one to sell when everybody wants to buy, and vice versa. Anybody who's trading, like in the futures, for example, in single tick type strategies, usually those strategies are based on book position, and all the markets don't match the same. Many are FIFO, first in, first out books. Are matching for the books, and then others are what we call allocation matching, where your position in Q is based on size. So, in the euro dollars, if you want to buy 100, you might have to bid 1,000 or 2,000 or 3,000 just to get allocated 100. Because the market doesn't move much, I guess is a blanket statement, but the idea being that when you've got, 100,000 by 90,000 in the queue in the front month, if you want to cross the spread, it would probably be a pretty good idea if you traded from the top of the book somewhere. Otherwise, you're getting swept out in the back, and, you're probably going to have a harder time doing it. So yeah, market making can mean all of those things.
Yeah, cool. Right, I just want to go over Discovery. Just talk about Discovery. Somebody asked what DTG is. I'm going to give my explanation first because...
it's way better than mine, so that's good.
So DTG, first of all, they're not masters of marketing. They're not out to get tons and tons of your money.
That's an understatement.
If they are out to get tons and tons of your money, they're doing it really badly. But
terribly, yeah.
It's a really interesting place. The best way to look at it is a trader development forum. So it's a paid forum. It's people go there and discuss, but they don't really care what you do in terms of strategy. But they're probably the very few, probably the only place I know that focuses on trader development, how to take something and make it work, and that's how me and Rob met. I saw this. I'm like, wow, that's really cool. And he heard about me and called me up and told me to stop telling people what I was telling them. You should stop teaching that, Pete. But it's really interesting. It's a very open place where everybody can talk about the strategy, and regardless of what strategy you've got, they can help you develop it. And I just think it's a really interesting concept. But again, it's not a real hard selling big marketing business. So if you didn't hear about them, that's probably, it's not your fault, is it, Rob?
No, no, and I mean, it was never intended to be. I mean, it just was sort of it grew up accidentally as a place where we just interacted with each other and our own kind of private things that we were doing, for business and otherwise. And then through a fortuitous series of events, which I won't go into, it just ended up getting opened up to a few strangers, and then it just grew into something that we really found beneficial, or everybody has, the process of interaction and constantly, beating up these concepts and developing strategies and risk models. And yeah, it's definitely a unique place. And I should probably also add that, Pete has been a member and a resident pro for some time, and there's some of his content is there. You guys can page through and see in the materials that the front of the site that Pete's showing here is just a blog that it originally was, and the main meat of it is there's a member forum behind where everything is, all the member webinar, content and all of the white papers for strategies, and all the members have journals and lay out, how they're constructing their strategies and risk models and, whatever. And you guys can find all that on your own. But so there's everything from intraday swinging type strategy people to scalpers to market makers. In fact, I just spoke with John Grady yesterday, and he's going to be coming in and doing regular video content on scalping stuff, which he's more on the market maker kind of end of scalping, which is, I think, will be a nice addition to the community. And then we have a guy, Dan, who's doing stuff with, longer term non-correlative portfolio design, core position, long index, selling options against the core position, and sort of, showing kind of what that looks like. And so it's pretty diverse. There's pretty much, something for everybody, I think. So we're pretty proud of it. It's a good place.
Yeah. And that's how we met. It sounds like a little romance, doesn't it?
It's sweetie.
And the funny thing is, whenever you meet somebody else in the industry, if you're in the industry, you're always really, really wary, because it's God, it's somebody.
Yeah, here we go.
Yeah, exactly. And and it takes it takes like a little while for that courtship to kind of blossom into a relationship. I mean, I had a conversation with one guy where we both spent the first 5 minutes saying, "Who the fuck are you?"
Yeah.
We didn't do that, Rob.
It's like that.
It can be like
it's almost like, it's like dog psychology, to a certain degree. It's like there's you just kind of have to sniff each other out and figure out what the story is. But yeah, so, just a note too on Jigsaw, now it's going to sound like we're plugging each other.
Sorry. Me and Dan, me and Rob have never plugged each other.
No, we haven't. The Jigs, boy, how do you follow that?
Just in case my wife's listening.
Yeah. Now she's really, no, I heard you, she'll say. So Jigsaw has been, just people are crazy about it. I mean, so many of our members have, it was our members that originally turned us on to the tools, and is how I met Pete and all that stuff. And it's great because, finally something's, been developed by a guy who actually uses the tools. And I think that's why. And obviously it doesn't help that he has, a background as a serious developer, because probably the thing that's almost taking over now that everybody has taken for granted that tools like this are available, is the, obviously the architecture of the software, and it works, and things like, you're not going to be frozen out in a dialog box and unable to access your orders because some crazy thing, happened in the software and stuff like that. So I think anybody who's serious about trading, having an execution front end that you can really trust, that it works, I think is probably, anybody would put at the top of the list as being the most important thing. And the rest is obviously functionality, which we all know now is top notch. But you don't have to remember things anymore. If you use I always say, people say, I always call these order flow based tools, I call them memory tools, because if you used to trade anything to do with the tape or the order book, you had to remember stuff. Price came down to a level and you're watching the tape and you go, oh yeah, it was, a lot of long stepping up at 35s, and that was like 10 minutes ago,
Yeah,
and
Rob,
now you could just look at the history of the prints and go, oh, look, there was, a lot of trading there.
and the funny thing was when people, because I actually met before I do Jigsaw, I met quite a few professional traders in Singapore, and when they were telling me about this stuff, I'm like, oh, so you're watching the orders and you're watching the trades, and well, the trades are there and the orders are there, and then they're telling me about, if it came back to that level that was, and I'm like, you came back to the level of 10 minutes. How do you remember what was there? I mean, like, I can't remember what I had for breakfast. I have a short term, and it was just like, that was what created the tools. Was like, I'm just looking at these guys and saying, you do what? And it's just like, I just think there's back then it was a big memory game, and to me it was like that would have been a showstopper for me personally, to have to remember stuff like that.
Yeah, well, and the older that you get, if that's something that you're interested in, it's just going to get harder, to do that stuff. So, yeah, we're probably close to the same age.
Yeah.
So,
all right.
Anyway, anything else? Any other quick questions before we go, or are we good?
I think we've kind of covered most of it. There were questions, and then I think we covered it.
Okay.
And so I think we're good. So Rob, thank you, and really appreciate it. Always good to talk.
Always fun.
Always been one of the traders I've respected and referred to as well.
We always threaten to record one of these conversations, so now we can say we've done it.
Absolutely.
So hopefully everybody didn't mind the looseness of it, but that was the intent. So.
No, that's the way they are, isn't it? But I think we actually we started in one place and ended up kind of full circle. So thank you, Rob. And I would like to thank everybody for attending. There will be a recording. What I'll do is I'll put it on SoundCloud and YouTube, so that if you want to listen to it on your mobiles, you young kids with your mobile devices, you can listen to it on the way to work or whatever. So thanks all, and have a great weekend.
Okay, thanks, Pete.